Hi, this is Professor Hazara, and this is for Business 402, Accounting 402, Advanced Accounting, obviously. Now, in looking at the syllabus, it looks fine, but Module 3, I told you in an email, I'm going to extend just Module 3 to include a couple of extra problems. And the reason I'm doing that is because in the textbook, the module only, or the chapter, I think it's chapter 4 actually, in the textbook, chapter 3 or 4, whatever, the one on consolidation subsequent to the date of acquisition, it only talks about consolidations that are 100%, where a company acquires 100% of another company. And that's fine. But you really have to know something about when a parent acquires a controlling interest like 60, 70, 80%, which is less than 100%. Once you pass the 50% threshold, you control another company. So you are called the controlling interest, the parent. And then you're going to have the other shareholders. Let's say you buy 80%. The other 20% of the shareholders are called the non-controlling interest. So, and most consolidations and acquisitions in real life follow this. 100% acquisitions happen sometimes, but not as often as acquisitions in which the controlling interest is less than 100% but greater than 50%, and when you have a non-controlling interest. So I think it's very important before we finish this module for you to know something about consolidations in which there is a non-controlling interest. It's not just important, it's vital. And this will probably be the big topic of test 2, is just a simple consolidation with non-controlling interest. The principles are the same as the one for 100% that you're working on as we speak right now. The one that's due on the 12th, I think, or whatever. The principles are the same, but the only thing we're going to be doing is we're going to be splitting all calculations between the majority, the controlling interest, and the non-controlling interest. Okay, so I've had to pull a couple of problems from another book so I can show you about this. And your book gets to it sooner or later, and down the road somewhere, but not soon enough, because this is something so fundamental consolidation that we have to talk about it. So I'm going to put up 3 videos. I'm going to try to keep them short. I'm going to introduce the problem in the first video. In the second video, I'm going to actually do the calculations and the journal entries for the problem. And then in the final video, I'll do the consolidation itself. Okay, so if you follow the 3 videos, you'll have a good example, and I'm actually going to have you do this as an assignment, so you're forced to do this. And then I'm going to have you do this. That's the first problem. The second problem, I'm going to actually give you an assignment which is similar to this one, but which you're going to have to figure out some stuff on your own. But it won't be hard. It's just the principle is the same, but you should know this before we go on to the more advanced topics of consolidations, which are like intercompany transactions. Okay, so let's start. So in the first video, we'll talk about, I'll just introduce the problem, and then I'll put up the solution on this Excel worksheet here. So let's go ahead and just start this problem here. Okay, so these are just 2 problems that I've sort of interplaced here in this part of the course, because you've got to know something about this. Okay, and this is the best copy I could make, and I'll put this in the assignment section. Okay, because it will be an assignment. Okay, so it says Park Corporation acquired a 70% interest in Solid Corporation's outstanding voting common shares on January 1, 2011. Okay, so that's easy enough for $490,000 cash. It's not a 100% acquisition. It's a 70% acquisition on January 1, 2011 for $490,000 in cash. Okay, the stockholders' equity of Sol on this date, on January 1st, 2011, consisted of $500,000 capital stock and $100,000 retained earnings. Okay, and that seems reasonable. So they're paying 70%. Or they're paying $490,000 for a 70% interest in a company with total equity of $600,000, $500,000 capital stock, $100,000 retained earnings. Okay, so the problem looks fairly similar so far to the others we've had. Okay, the difference between the fair value of Sol and the underlying equity, these are the revaluations we've been dealing with all semester long. $5,000 goes to undervalued inventory. $14,000 goes to undervalued buildings, $21,000 goes to undervalued equipment, and $60,000 to goodwill. Okay, so you're paying $490,000, so you only own, but for only 70% of the company, and they have figured that when they figure out the fair value of Sol, that that Sol's fair value, there's going to be a difference between the amount paid and the book value they receive, and that difference is going to go 5,000 to inventory, 14,000 to buildings, 21,000 undervalued equipment, and 60,000 to goodwill. So there's some goodwill. That's the first paragraph. Okay, now the second paragraph. Second paragraph. The undervalued inventory items were sold in 2011. Okay, so all they're saying here, I'm just describing the problem. So what they're saying is that this 5,000, the 5,000 is going to be written off all in the current year 2011. This is the first year consolidation because the inventory was sold at that time. And then it says that the undervalued buildings and equipment had useful remaining lives of 7 and 3 years. So we'll be depreciating those over 7 and 3 years respectively. Okay, and those are going to be adjustments to the equity method, the consolidated net income. Okay, and then it says at December 31, 2011, Sol's accounts payable included Sol's accounts payable included 10,000 owed to par, and these are just basic things you'll see in consolidation problems where one company owes the other some money, and you're going to have to just take 10,000 out of accounts receivable and 10,000 out of accounts payable, because from a consolidated view, they're both one company, so you can't owe yourself money. But these are very easy journal entries. And then there's a sentence in the third paragraph. You say it says, par sold equipment with a book value of 15,000 for 25,000 on June 1, 2011. In CPA exams, they love to give you irrelevant information. And I'm telling you right now, that information, this was an old CPA exam problem, is irrelevant, okay, because it has nothing to do with anything. Okay, it just says that they sold some equipment. That's all. It says this sale is not an intercompany sale transaction. You'll learn about that in the next module. But that's why I'm doing these problems. Okay, and then separate financial statements for par and Sol are summarized as follows. Now, I would like to emphasize here that the financial statements, these are the financial statements that we're going to use in the consolidation over here, in this worksheet over here. And you can see that, I've got all the calculations here. Let's see here. But there's the consolidation worksheet here. That the financial statements that are in the text of the problem are the same financial statements that I am highlighting here. Those financial statements are the same as the text of the problem right there. Okay. Now, one important thing to realize is that, I'll go back to the text of the problem here. One important thing to realize is that PAR's financial statements right here that you're looking at are its post-equity method financial statements. And there's a reason why I gave you those problems before. I wanted to emphasize that when a parent consolidates its financial statements, they must be post-equity method. The parent must have already used the equity method in its own accounting system, and then the results of the equity method should be in the parent's financial statements, but before it does the consolidation. And there's two ways, two accounts you'll see here that confirm that. The first account is, and I'll try highlighting it, I'll actually draw a circle around it. The first one is this one right here. That's income from sub. The parent, PAR is the parent, in its own accounting system, has used the equity method and computed income from sub, from Sol, of 60,200, whatever thousands, whatever, but 60.2, whatever units are. So you always look to make sure that before doing a consolidation and transferring the parent's financial statements to the consolidation worksheet, that it's already used the equity method. Well, it has, because you've got the income from Sol account. That's the result of using the equity method. The other account that you've got to look at, and it really is more important in a sense, is this one right here. That one right there is the investment account. That's the equity method investment account. So the parent, these are the same financial statements that you're going to see on the worksheet that we're going to build the consolidation on, which we're going to build the consolidation. And you're going to see, and I'm going to end this video here. See how quick I'm being on these videos? You're going to see on the video that on the worksheet that these are the same financial statements. And I'm going to confirm to you just now before stopping this video that the parent has 60.2 income from SOL on its post-equity method income statement that it's going to use in the consolidation, and that it has investment in SOL of 515.2, which is going to be on the balance sheet that it uses for the consolidation. And here's the confirmation right here. Okay, so this is going to be, these are the consolidation working papers right here. Those are the consolidation working papers. There is right there, I'll highlight it, there is your income from SOL of 60.2, and here is your investment account, investment in SOL of, and we'll highlight that too in red and even make it bold. So we have the 60.2 right there, and we have the investment in SOL account right there. So we're going to consolidate these financial statements, and I'm going to go ahead and make all these amounts zero going down. So I'm prepping the worksheet to do the consolidation. But the first thing I'm going to do is I am going to, first of all, I'm going to stop this video and then what we're going to do in the next video is I'm going to do the preliminary computations, and then in the final video we're going to do the consolidation entries and the consolidation. Okay, so this is the first video. The next two are going to be a little longer, but I'm trying to keep these short. I'm learning how to make these videos. Okay, so this is the first video in this problem.